Gold just hit record highs. Silver was surging like never before. Investors were celebrating. They thought they had finally cracked the code. Then everything stopped. In just 48 hours, billions vanished. Portfolios that were glowing green turned deep, painful red. And right now, thousands of investors are doing the one thing that will cost them everything. But here is what nobody is telling you. This decline is not what it appears to be. And the investors who fall for it will miss the biggest opportunity of the entire decade. Are you one of them? Welcome to Silver Radar, the one channel that tells you what the markets are actually doing, not what they want you to believe. Now, if this is your first time here, do me a favor. Think of it this way. You know that one elder in your family, maybe your grandfather, maybe an old uncle, the one who never gives bad advice, the one everyone quietly listens to. When the room gets serious, that is what this channel is. So do what you would do for him. Hit that subscribe button. Show him some respect. Because the knowledge we share here is not something you find everywhere. Now, before we dive deep into why this gold and silver decline is misleading a lot of investors, drop a comment right now. Tell us, which country are you watching this from? We want to know how far Silver Radar is reaching. Now, stay close, because what comes next will change the way you look at these markets forever. The screen opens on a dark, empty trading floor. Silence. Then, one single red number flashes on a monitor. Gold, down. The camera holds on that number for 3 full seconds before pulling back to reveal dozens of screens, all glowing red. The narrator begins. Every single day, millions of investors wake up and do the same thing. They check their portfolios. They read the headlines. They make decisions based on what they see on the screen. And for most of them, that habit has cost them more money than they will ever admit. A close-up of a man's hands. He is scrolling through his phone, his portfolio. Green last night, deep red this morning. His thumb hovers over the sell button. He does not move, not yet. But this week, something happened that exposed exactly how dangerous that habit truly is. Something that played out in plain sight, in front of everyone. And yet, almost no one understood what was actually taking place. The narrator's voice carries a calm but deliberate weight. On the final stretch of January, gold and silver were behaving like unstoppable machines. Prices were surging. Headlines were bold. Investors across the world were watching with wide eyes. For a moment, it felt like nothing could stop them. A clean timeline graphic appears on screen. It shows gold's price climbing sharply over the last 2 weeks of January. Smooth, powerful, almost hypnotic. The audience watches the line rise steadily higher and higher. Gold was breaking records. Silver was following with force, and the narrative was simple. The bull run is here. Get in now, or get left behind. Then the graphic freezes. A single violent red candle drops on the chart. The narrator pauses for 2 full seconds. Let the silence do the work. And then, in just 48 hours, everything changed. A woman sitting in a quiet office. She is reading a financial news article on her laptop. Her expression shifts from calm to concerned. She closes the laptop slowly. She does not open it again for the rest of the morning. The sell-off hit without warning, without preparation, and without mercy. The narrator's tone sharpens slightly, not with emotion, with precision. This was not a small correction. This was not a minor adjustment. This was a violent, sharp sell-off that erased days of gains in a single trading session. Gold dropped, silver dropped harder, and the market offered absolutely no warning before it happened. A graphic shows the 2-day price drop placed side by side with the previous rally. The contrast is stark. The audience can feel the weight of what just happened without anyone needing to explain it. Billions of dollars in value, gone. Just like that, in 48 hours. A busy coffee shop. People are sitting with laptops open. One man refreshes his trading app repeatedly. His jaw tightens with every refresh. He is not drinking his coffee. He has forgotten it is there. And across the world, investors started asking the same question, the same dangerous question. The narrator delivers the line with weight. Is this the top? Have we just seen the end of the rally? Should I sell everything before it gets worse? A simple timeline appears. 2 dates are marked. The rally, then the drop. Between them, a single word is displayed. Delivery season. The narrator lets the audience read it before speaking. But here's the part that most people completely missed. This sell-off did not happen because the market changed its mind. It did not happen because gold and silver lost their value. It happened because of something very specific, something tied directly to the futures market calendar. A senior analyst is standing at a whiteboard. He draws a single downward arrow. He does not explain it. He does not need to. The room already understands. The front-month futures contracts on the main U.S. exchange were entering their delivery period, and for anyone who understands how these markets actually work, this moment changes everything. The narrator continues with measured urgency. When delivery season arrives, the rules of the game shift. Traders who held speculative positions now face a very real and very expensive decision. They must either accept physical delivery of the metal, or they must exit their position before the deadline arrives. And exiting means selling. 2 boxes appear on screen, one labeled Hold and Take Delivery, one labeled Exit Now. A red arrow points firmly toward the second box. The narrator lets the visual breathe, and the majority chose to exit. A young entrepreneur sitting alone in a dimly lit room. He is watching his screen. His face is lit only by the blue glow of the monitor. He looks uncertain, but he does not close the screen. He keeps watching. When they did, the selling pressure hit all at once. That is why the drop felt so sudden. That is why it felt so violent. It was not random. It was mechanical. It was scheduled. And it was completely predictable, if you knew where to look. The narrator now shifts the tone, calm, strategic, almost conversational. But here is where the real danger begins. Because the moment investors saw those red numbers, the instinct kicked in. The same instinct that has existed in human beings for thousands of years. The instinct to run. The instinct to protect. The instinct to sell before it gets any worse. A slow motion replay of the price chart dropping plays on screen. Each red candle falls one by one. The audience watches it happen in real time. The rhythm is almost hypnotic in its destruction. And that instinct is exactly what the market was waiting for. An older businessman walking through a city street at night. The lights of financial buildings glow behind him. He walks with purpose. He does not look at his phone. He does not need to. The market does not only move on truth, it moves on positioning, it moves on who is trapped, it moves on who needs to unwind, and it moves on the clock. Time matters more than most people ever want to admit. The narrator delivers the next statement with deliberate calm. The sell-off you're seeing right now is real. The prices did fall. The losses on your screen are real. But the conclusion that most investors are drawing from this moment is completely wrong. And acting on that conclusion could be the most expensive mistake of the entire year. A split screen appears. On the left side, retail investors are selling in panic. On the right side, a quiet room where larger players are watching screens with calm, focused expressions. No one on the right side is moving quickly. 2 different worlds, 2 different reactions, 2 completely different outcomes waiting at the end. The narrator continues, his voice steady, his words chosen carefully. The market plays tricks, not because it is alive, not because it has a mind, but because of the way human beings react to pressure. And this week, it played one of the cleanest tricks it has played in months. 3 words appear stacked vertically on screen. Positioning, then pressure, then time. Each word appears one by one. Each one lands with quiet force. The narrator does not rush. These 3 forces are what actually moved the market this week. Not fear, not fundamentals. These 3 forces. And understanding them is the difference between losing money and making it. A young woman in a university library. She is studying economics. She pauses mid-sentence in her textbook. She looks up. Something has clicked. The camera holds on her face for a moment before moving on. The investors who see only the price will continue to react. The investors who see the structure behind the price will begin to act. And acting in this market, right now, is where the real opportunity lives. The narrator delivers the closing statement of part 1 with full weight. The gold and silver decline is real. No one is denying that. But the story behind it, the reason it happened, and what comes next, is something the headlines will never tell you. And that is exactly what Silver Radar is here to show you. The screen fades to black. Silence holds for 2 full seconds. Then a single line of white text appears slowly. Why do prices fall without the trend dying? The answer is coming next. Darkness. Complete and total darkness. Then a single gold coin drops. The sound echoes like it is falling through an empty cathedral. It hits the ground, and the screen cuts to white. You have ever watched a river during a storm? The narrator pauses, lets the question sit. The water gets rough, it gets loud, it looks dangerous. But underneath all that chaos, the river is still flowing, still moving, still heading exactly where it was always going. The surface lies, the current tells the truth. A massive river appears on screen, violent on top. But underneath, through clear water, the flow is steady, calm, unstoppable. The audience watches both layers at the same time. Gold and silver right now are that river, and the sell-off you're seeing is nothing more than the storm on top. The camera slowly descends beneath the water. The chaos above disappears. Everything becomes quiet. Everything becomes still. The narrator lets this moment breathe for 3 full seconds. But to truly understand why precious metals can fall this hard, without the bigger trend breaking, you need to go beneath the surface. You need to see what is actually happening in the mechanics of these markets. Because once you do, you will never look at a price chart the same way again. A busy trading floor. But this time the camera does not focus on the screens. It focuses on the traders themselves, their body language, the way one man grips his desk, the way another taps his pen against the table in a nervous rhythm. These are not calm professionals. These are human beings under pressure. The first thing you must understand is that precious metal prices in the short term are not driven by how much gold exists in the ground. They are not driven by how many countries are buying. They are driven by something far more immediate, far more human. They are driven by positioning. The word positioning appears on screen in large, clean letters. It stays there for 4 full seconds. The narrator does not rush past it. Positioning simply means, where are the traders standing right now? Are they betting that prices will go up? Or are they betting that prices will go down? And here's the critical part. When too many of them are standing on the same side, the market does not stay there. It tips. And when it tips violently. A simple balance scale graphic appears. One side is loaded with weight. It holds for a moment, then it crashes to the ground. Well, the metaphor is immediate and powerful. In the final days of January, positioning in gold and silver was extraordinarily one-sided. Traders had piled into long positions. Everyone was betting on higher prices, and that created something the market cannot sustain. It created a fragile structure, a house of cards built on confidence, and all it took was one push to bring it down. An old man is sitting alone in a wooden chair by a window. Outside it is raining heavily. He is watching the rain fall. He does not look worried. He has seen storms before. He knows they end. The second force is liquidation pressure, and this one is where most investors get completely lost. The narrator slows his delivery. Each sentence is placed with surgical precision. When traders decide to exit a position, they do not disappear quietly. They sell. And when hundreds of traders exit at the same time, the selling hits the market like a wave. Not a small wave. A wave that moves prices in minutes, not hours. Minutes. A series of dominoes appears on screen. They are standing in a long line. The first one falls, then the second, then the third. Each one knocks down the next with mechanical certainty. The chain reaction plays out across the entire screen. This is what happened during the January sell-off. It was not one big event. It was a chain reaction. One trader exits. That pushes the price down slightly. That triggers another trader to exit, which pushes it down further. And before anyone fully understands what is happening, the damage is already done. A young woman is sitting at a desk in a modern apartment. She's not watching the news. She is studying data on her laptop, charts, numbers, patterns. Her focus is total. Her expression reveals nothing. She's not reacting. She is analyzing. But here's what makes this even more interesting. This liquidation did not happen randomly. It happened at a very specific time, and that timing is connected to the third force, the contract calendar. The screen displays a large, clean calendar. Most of the dates are empty, but a handful of dates at the end of the month are highlighted in deep red. The narrator points to them with quiet authority. Futures contracts are not like stocks. They do not just sit there indefinitely. They have expiration dates. They have delivery deadlines. And when those deadlines approach, traders must make a choice. They must either roll their position into the next contract month, or they must close it entirely. A close-up of a clock, and the hands are moving, but they are moving faster than normal. Time is not waiting. The narrator speaks over the image. Rolling a position costs money. It takes effort. It requires confidence that the trade is still worth holding. But when the market is already feeling shaky, when positioning is already stretched, the easier choice is to simply exit. And that is exactly what happened. A long corridor, empty. The lights flicker slightly. At the end of the corridor, a single door is open. Light is coming through it. The narrator speaks. Now, combine all 3 forces together. Overcrowded positioning on one side, liquidation pressure hitting in waves, and a delivery deadline forcing traders to act before time runs out. What you get is not chaos. What you get is a perfectly predictable sequence of events that looks like chaos to anyone who does not understand the structure. A woman is standing on a balcony overlooking a city at dusk. The wind is moving through her hair. She is holding a coffee cup, but she is not drinking. She is thinking. The city below her is loud, but she is quiet. This is the secret that separates the investors who survive these moments from the ones who do not. It is not about being smarter. It is not about having more money. It is about understanding that short-term price movements and long-term trends are 2 completely different conversations. and confusing them is where fortunes are lost. A graphic now appears, showing two lines on the same chart. One line is jagged, violent. It drops sharply. This is labeled short-term price. The other line moves steadily upward beneath it. This is labeled long-term trend. The audience can see both lines exist at the same time. Gold and silver dropped. That is the short-term price. It is real. It hurt. But the long-term trend, the structural demand from central banks, the inflation pressures, the global uncertainty driving safe haven flows, none of that disappeared. Not one piece of it changed. A train is moving through a tunnel. It is dark inside. But at the end of the tunnel, light. The narrator speaks over this image with calm certainty. The sell-off was the tunnel, dark, uncomfortable, frightening for anyone who did not know what was on the other side. But the light at the end was never removed. It was always there, waiting. The narrator delivers the closing statement of part 2 with deliberate weight. The gold and silver decline did not kill the trend. It tested it. It shook it. It made millions of investors question everything they believed 2 days earlier. But the structure beneath the surface remained exactly where it was. And the investors who understood that are the ones who will be rewarded when the next leg higher begins. The screen fades to black. Silence holds. Then a single line of white text appears. But has this exact pattern happened before? And what did the market do after the last time it looked exactly like this? The answer will challenge everything you think you know. The audience is left waiting. A single match strikes in complete darkness. For 1 second, the flame illuminates an old photograph, a newspaper headline from decades ago. The match burns out, darkness again. Then another match, another photograph, another headline. A different era, a different crisis, but the same feeling. The narrator begins with a voice that carries the weight of time itself. There's a saying that has existed in financial markets for over a century. History does not repeat itself, but it rhymes. And in precious metals, it does not just rhyme. It sings the same song again and again and again. The only difference is how many investors are paying attention when it does. An old archive room appears on screen. Dust particles float in a beam of light cutting through a small window. Shelves stretch from floor to ceiling. Thousands of folders, thousands of records. Decades of market behavior, all stored in silence, waiting to be read. Tonight, we are going to open 2 of those folders. 2 moments in history where gold and silver did something almost identical to what just happened in January. A massive rally, a violent pullback, and then a silence so heavy that most investors convinced themselves the story was over. A hand reaches into the frame. It pulls a single folder from the shelf. The dust lifts slightly as it moves. The camera holds on the folder for 3 full seconds before it is opened. It was not over, not even close. And what happened next, in both of these moments, will make you rethink everything you believed about this week's sell-off. A dusty classroom, old wooden desks, a chalkboard at the front covered in numbers and arrows. No one is sitting in the chairs. The lesson was given long ago. But the evidence remains on the board, written in chalk, fading but still visible. The first pattern, and pay close attention here, because the structure of this moment is so close to what we are seeing right now that it is almost uncomfortable. The narrator pauses, lets the tension build. During a period of rising global uncertainty, gold surged, not by a small amount. Gold surged with force and speed that caught even seasoned analysts off guard. Silver followed. Both metals were moving with an energy that felt almost electric. Investors who had been waiting on the sidelines suddenly rushed in. They did not want to miss what appeared to be the beginning of something historic. A black and white photograph of a crowded trading floor, traders shouting, papers flying, chaos in its purest form. But beneath the chaos, a market that had already made its decision. The crowd simply had not caught up yet. And then the sell-off came, sharp, sudden, brutal. Within days, the gains that had taken weeks to build were cut in half. Portfolios that had been glowing green turned a sickening shade of red, and the narrative shifted overnight. The bull run is finished. Sell before it gets worse. Get out now. A single newspaper front page appears on screen. The headline is bold. The ink is dark. The words communicate fear. The narrator does not read the headline. He does not need to. The audience can feel what it says. And here is the moment that matters. The moment where the outcome was decided, not by the market, but by the investor. The screen splits into 2 separate timelines. Left side, right side. 2 paths, 2 choices, 2 completely different futures unfolding from the same exact starting point. The investors who listened to the fear sold. They locked in their losses. They walked away believing they had made the smart decision. The investors who studied the structure held. They did not enjoy it. They did not feel confident, but they held. A man is sitting alone in a dark room. A single lamp is on beside him. He's holding a glass of water, but he is not drinking. He's staring at nothing. The weight of a decision he has already made is sitting on his shoulders. He does not move. Within weeks, gold did not just recover, it surged past every previous high. Silver did the same. The investors who had sold watched from the outside as their former positions moved to levels they had never imagined possible. The investors who held saw their wealth multiply in a way that no headline ever predicted. A graphic appears showing the exact price movement after that first historical pullback. The line drops sharply, holds for a moment, then explodes upward. The move higher is not subtle, it is violent, it is powerful, it is undeniable. Pattern 1, complete. And the lesson it left behind was clear. The sell-off was not the end of the story. It was the setup for the most powerful chapter that followed. The narrator allows silence to sit for 2 full seconds. Then he continues. Now, the second pattern. And this one is even closer to what is happening today. A woman is walking through a long corridor. The walls on both sides are lined with glass cases. Inside each case, a single gold coin. Each coin is from a different era, different civilizations, different centuries. But all of them survived. All of them held their value. She walks past them slowly. She does not stop. She already knows the lesson. This second moment occurred during a time when inflation fears were rising, when central banks were making decisions that confused the market, when uncertainty was spreading across borders like smoke. Sound familiar? The narrator lets that question land. He does not answer it immediately. Gold and silver rallied hard. The momentum was fierce. Investors piled in with conviction. And then the pullback arrived. Once again, sharp. Once again, violent. Once again, completely terrifying to anyone watching from the outside. A close-up of hands, not scrolling a phone this time. These hands are gripping the edge of a wooden table. The knuckles are white. The body language says everything the narrator does not need to say out loud. This is what fear looks like when it lives inside a portfolio. The headlines screamed. The analysts warned. The social media feeds were flooded with predictions that the era of rising precious metals was finished. And for a brief moment, it almost felt believable. A single candle is burning in an otherwise dark room. The flame flickers. It bends. It almost goes out. But it does not. It holds. It straightens. And it burns again with steady, quiet intensity. But it was not believable, because the fundamental forces that had driven gold and silver higher in the first place had not changed. Not one single force. The inflation was still there. The uncertainty was still there. The structural demand was still there. The pullback changed the price. It did not change the trajectory. A graphic now displays the second historical pattern. The structure is remarkably similar to the first. Rally, violent drop, silence, and then the explosive move higher that followed. The audience does not need to be told to notice the similarity. They see it on their own. Within months, gold and silver moved to levels that the so-called experts had publicly declared impossible. The sell-off was not a warning. It was not a signal to exit. It was a loading dock, a place where the market quietly picked up the investors who understood what was happening and carried them to the next level. An old man is sitting on a wooden bench outside a library. The evening light is fading. He is not reading. He is not on his phone. He is simply sitting, watching the world move around him. He has seen enough cycles to know that patience is not weakness. It is the most powerful weapon an investor can carry. 2 patterns. 2 almost identical setups. 2 violent sell-offs that created genuine fear across the investor community. And in both cases, the market moved significantly higher afterward. Not eventually, not maybe, it moved higher. With force, with certainty, with the kind of momentum that only exists when the structure beneath the surface was never actually broken. A side-by-side comparison graphic now fills the screen. Pattern 1 on the left, pattern 2 in the center, the current moment on the right, 3 setups laid out together. The similarities are not subtle, they are precise. The audience can see the echo clearly. This does not guarantee that history will repeat itself one more time. Nothing in financial markets comes with a guarantee. But when the same structure appears and produces the same result more than once, ignoring it is not caution. It is not wisdom. It is a decision, a conscious decision to look away from evidence. And in this market, that decision has a price. A young entrepreneur is sitting at his desk, late at night. The room is quiet. He's not working on anything. He is simply thinking. His hands are folded. His eyes are focused on something only he can see. A decision is forming. The camera holds on this moment without rushing it. The investors who fell for the fear during those 2 historical pullbacks paid for it with their portfolios. The investors who studied the pattern, studied the structure, and acted on what the data was telling them instead of what the headlines were screaming, they are the ones who built real wealth from these exact moments. The narrator delivers the closing statement with full weight and quiet authority. Gold and silver are falling right now. The headlines are loud. The fear is real. But the history, the actual documented history of what happens after moments exactly like this one, is not loud. It is not dramatic. It is simply there, waiting, for anyone willing to look at it honestly. And what it shows is not a warning to sell. It is an opportunity that most investors will miss. Again, the screen fades to black. Silence holds for 3 full seconds, longer than before. The weight of everything that was just said fills the darkness. Then a single line of white text appears, slowly, word by word. The patterns have spoken, but while retail investors are reacting to fear, what are the largest, most powerful players in the world actually doing with their money right now, behind closed doors? The answer will change everything. It is coming in the final part. The audience is left waiting. Then, a single heartbeat. Low, deep, almost like a drum hitting once from somewhere far away. The screen remains completely dark. Another heartbeat. Slightly louder this time, then silence again. The narrator begins. His voice is different now, quieter, more deliberate, as if he is sharing something that was never meant to be spoken out loud. Everything you have watched until this point has been about what is happening on the surface, the price, the headlines, the fear, the panic. But now, we're going somewhere else entirely, somewhere most investors never go, because most investors do not know it exists. A massive steel vault door appears on screen, ancient, thick, cold, the kind of door that does not open for just anyone. The camera holds on it for 4 full seconds. No movement, no sound, just the weight of what is behind it. Behind this door, decisions are made that move markets before the public ever knows they happened. Behind this door, money moves in ways that retail investors will never see on their screens. And behind this door, the truth about gold and silver right now is already written. A long hallway inside a high-rise building, glass walls on both sides. The city stretches endlessly in the background, but inside this hallway, everything is controlled. Everything is intentional. A man in a dark suit walks slowly toward the end of the corridor. He does not look left. He does not look right. He already knows exactly where he is going. To understand what is truly happening in precious metals right now, you cannot look at what retail investors are doing. You cannot trust what the news is saying. You must look at the only source of information that has never lied. The actions of the largest, most powerful players on the planet. The narrator pauses. Lets the weight of that statement settle into the room. Central banks, institutional funds, the entities that move billions of dollars, not in days with us, but in hours. These are the players whose behavior tells you where the market is actually heading. Not where it feels like it is heading, where it is actually going. A woman in a tailored suit is walking through the marble halls of a central bank. Her footsteps echo against the stone floor. She carries a leather folder close to her side. Her expression reveals absolutely nothing. She has done this 1,000 times. She will do it 1,000 more. And right now, what these players are doing is the opposite of what the headlines are suggesting. A clean graphic appears on screen. It shows central bank gold purchases over the past 24 months. The line does not spike. It does not crash. It simply climbs, steadily, consistently, month after month, like a heartbeat that never stops beating. Over the past 2 years, central banks around the world have been purchasing gold at a rate that has not been seen in over a decade. This is not a rumor. This is not speculation. This is documented data, filed, reported, publicly available, and it tells you something that no headline will ever say out loud. The narrator speaks with surgical precision. The most powerful financial institutions on the planet do not believe this bull run is over. They are not selling. They are not waiting. They are buying, quietly, consistently, and with a conviction that only exists when the long-term outlook is already decided. A quiet room somewhere deep inside a financial institution. 2 men are sitting across a table. No phones, no laptops. A single document sits between them. The camera does not reveal what is written on it. One man nods slowly. The other closes his eyes for a moment. The decision has already been made. This meeting is simply confirmation. But central bank behavior is only the first layer. The second layer is where it gets even more interesting. A positioning chart fills the screen. 2 lines moving in opposite directions. One line represents retail investor flow. It is dropping sharply, moving downward with speed and fear. The other line represents institutional flow. It is moving upward, slowly, but with unmistakable intention. While retail investors were rushing toward the exit during the January sell-off, institutional positioning told a completely different story. The largest funds were not running. They were not panicking. They were not even slowing down. They were adjusting their positions, tightening their strategy, and in many cases, they were adding to their holdings. An older man is sitting in a leather armchair inside a study lined with books. He is reviewing a document on his desk. His reading glasses sit low on his nose. He picks up a pen. He circles something on the page. He does not react emotionally. He simply moves to the next page. This is not a man who makes decisions based on fear. This is a man who makes decisions based on data. This is the single most important distinction in all of investing, and most people never learn it. It is not intelligence that separates the winners from the losers. It is not connections. It is not luck. It is the willingness to look at what the money is actually doing, instead of what the voices on television are saying. The screen displays a single sentence, large, clean, white text against black. No decoration, no graphics, just words. The sell-off is not a warning to exit. It is a window to enter. The narrator lets that sentence sit on screen for 5 full seconds. He does not explain it. He does not elaborate. He lets it speak for itself. But entering a position during a pullback requires something that most investors simply do not have. It requires conviction, and conviction cannot be built on hope. It cannot be built on emotion. It can only be built on understanding, on a deep, unshakable knowledge of what the structure beneath the surface is actually telling you. A city waking up at dawn, the first light hitting glass towers, streets still empty. The world has not started yet, but the markets have already been moving for hours. The narrator speaks over this image with quiet authority. So let us look at that structure. Let us look at the macro indicators that are operating right now beneath the sell-off, the indicators that institutional players are reading every single morning before they make a single decision. A series of graphics appear one after another. Each one is clean. Each one is precise. Inflation data, still elevated. Currency movements. The dollar showing signs of weakness. Geopolitical tensions, rising across multiple regions simultaneously. Safe haven demand, increasing. Each indicator appears for 3 seconds. Each one points in the same direction. The audience does not need to be told what they are seeing. The pattern is unmistakable. Every single macro indicator that historically supports rising precious metal prices is still active, still in place, still building pressure beneath the surface. The sell-off did not eliminate these forces. It did not reduce them. It did not change them in any way. It simply buried them beneath a layer of short-term noise that most investors mistook for the entire story. A young woman is standing at a wide window in a modern office. The morning light is coming through the glass. She is holding a tablet in one hand. Her eyes are scanning data, not headlines, data. Her posture is calm. Her focus is absolute. She's not reacting to this week. She is positioning for the next 6 months. This is the gap between where retail sentiment is right now and where the actual fundamentals are pointing. And that gap is exactly where opportunity lives. It has always lived there. In every single major move in precious metals history, the opportunity was never loud. It was never obvious. It was quiet. It was patient. And it rewarded the investors who had the discipline to see it. A single candle burns in a dark room, not flickering, not struggling, burning with steady, unbroken intensity. The flame is perfectly still. The narrator speaks over this image. Gold and silver are not falling because the world has become safer. They're not falling because inflation has disappeared. They're not falling because central banks have changed their minds. They are falling because of short-term mechanical pressure that exists within a very specific and very limited window. And once that window closes, the structural forces that drove the rally in the first place will resume exactly where they left off. The vault door from the opening of this part appears again on screen, but this time it is not closed. It is open, slowly, deliberately. The camera moves through the doorway into darkness, but the darkness is not empty. It is full of something. The audience can feel it without seeing it. The smart money understands this. The institutions understand this. The central banks understand this. They have understood it for months, and they have been acting on it quietly while the headlines continue to scream about decline and collapse and the end of the bull run. A boardroom. A large screen at the front displaying a single slide. 2 words written in clean, bold letters. Long-term positioning. A senior executive is standing beside the screen. He is not raising his voice. He does not need to. Every person in the room is already leaning forward, already listening, already convinced. The investors who fall for this decline will watch from the sidelines. They will read the next set of headlines when gold and silver move higher again, and they will ask themselves the same painful question they have asked after every single previous pullback they reacted to with fear. Why did I sell? Why did I listen to the noise instead of the signal? A young entrepreneur is sitting alone on a rooftop at night. The city is spread out below him in every direction. Lights stretching as far as the eye can see. He's not looking at his phone. He's not scrolling through news. He is simply sitting with a decision. A quiet, powerful decision that no one else can see. But the camera holds on his face long enough for the audience to understand. He has already made it. The market will always create these moments. It is designed to. It needs the fear. It needs the panic. It needs the selling. because that selling is what creates the entry points for the players who understand what is actually happening. And right now, this is one of those moments, clear, documented, supported by history, supported by institutional behavior, supported by every macro indicator that matters. The narrator delivers the final statement of the entire video. His voice is not loud. It does not need to be. It carries the weight of everything that came before it. The gold and silver decline is real. No one here has ever denied that. But the story it is telling is not the story most investors believe it is. The decline is not the warning. The decline is the invitation. And the investors who recognize it for what it truly is will not just survive this moment, they will be the ones who look back on it as the most important decision they ever made. The screen fades to black, slowly, not all at once. The darkness creeps in from the edges, and as it does, the heartbeat from the very beginning of this part returns. 1 beat, 2 beats, then silence. A single line of white text appears, word by word, slower than any text that has appeared in this entire video. Silver radar. A pause. Watch. Learn. Decide. The screen holds on these words for 5 full seconds. Then it disappears completely. The video ends in total silence. No music, no outro. Just stillness.